Good morning, Angel. Are you all caught up? Did you watch all the videos? Good morning, Angel. You all good? Still watching is fine. Just keep watching. Let's wait a little bit for the others. Let's see who comes in. What do you mean? Right. Yeah, I taught the two variable statistics in the videos. So you can make the historical data calculations with the calculator, but you will have to make the ex-ante data calculations with Excel, or if you have the HP calculator, you can do it. You can do the ex-ante. All right, that's enough time. My gosh, 10 minutes already. All right, so I left off looking at this example to explain portfolio theory. And I said that we're going to plot risk and return, where risk will be measured by the standard deviation of the portfolio. Here is the formula in general, and we'll imagine that the standard deviations will be given and the correlation between two assets. So for instance, let me add, and then what we're going to do is decide or look at choosing the weights. And the weight should sum to 1. So here with the data, for instance, that that you've been given. I leave the weights out, and then I vary the correlation coefficient looking at the possibilities, the limits of the possibilities for the standard deviation using the extremes -1 and +1, and then no correlation. And it demonstrates that with the weights being mostly reflecting that you have mostly the risky asset, we see that that has the highest expected return, but it's accompanied by the highest risk when you compare it to the other scenarios. And the weights that introduce more of the less risky asset have the least or lowest standard deviation of the portfolio, but the lowest expected return. And that is for the setting where they're perfectly negatively correlated, perfectly positively, or not correlated at all. And then these are plotted here. And so each separate line indicates all the possible combinations. In this case, where correlation is -1. This is a pattern that's not unique to this example. You will see this pattern for two assets, looking at all possible combinations, given all possible combinations of weights. And if the correlation is -1, you can expect this pattern, that it will go all the way back. So what is this? This would mean that the correlation is 0. I mean, the standard deviation for the portfolio is 0. That's the best you can do, isn't it? No risk. So this is only possible when correlation is -1. So perfectly negatively correlated assets, you can find a combination that will give you a standard deviation of 0 in the portfolio. So a no risk portfolio. That's not possible when the correlation is 0. The best, you can't take advantage of diversification, in other words, because the correlation is not negative and you can't diversify. So this is just showing all the possible outcomes as you put more of the risky asset into the portfolio, and it is a straight line here. Now there's a few here that we're going to talk about as well. We're going to talk about these in a moment. What do we say about these ones here, these combinations? And then there's this is where correlation is perfectly positively 1. There is no diversification, but this is showing you all the possible combinations. So investors want to choose, given their correlation, whatever exists, they want to choose where to be among these combinations. So if the correlation was perfectly -1, where would they want to be? Would they want to purchase any of these portfolios with a combination starting here? XZ here is 100% and XY here is 0. Now as we move, we put more of Y in there, and we might be interested in this one here. This is known as the minimum variance portfolio. I know we plotted standard deviation, but it would work to say the same of the variance, wouldn't it? So we just call it the MV or the MVP. So between here and here, all these combinations, all these combinations here are what we want to look at right now. Let's say you're here with 100%, looking at 100% invested in Z and nothing in Y. If you put more into Y, you reduce your risk, standard deviation goes back down, and you increase your return. So this would be preferred to this one down here. But I could say that I could use the same argument all the way up here until this point, because I have done two things I like: reduce risk and increase return. So none of these would exist, right? Investors wouldn't choose, rational investors wouldn't choose any of these. They would begin here among their choices, and because this is where the trade-off starts. Now, where an investor would choose to purchase between the minimum variance portfolio and here, based on how much they invest of Y in Y, this depends on the investor's risk tolerance. Okay? So investors like to reduce risk and increase return. Okay? That's if you can go left and up, you'll always choose left and up. But then the trade-off kicks in, and as you look at the options here, yes, you can increase your return, but only at the expense of increasing your risk. So that's the case for correlation of -1. Now, if there is a correlation between two assets, and it's not -1, but it's not 0, so it's somewhere in between, you will see that there'll be like a curve, and this will bend back a little, but then have the same general shape. If the correlation between two assets is 0, so they're uncorrelated, there'll be a few options, going from 100% investment in Z, adding in some of Y, that will increase the return but not decrease the standard deviation. So you would, again, none of these would be chosen. This one would be preferred. So those options would begin choosing from here, right? Because this is higher return relative to all of those. This is the preferred one. So it would be any of those options. And then from here to here, it's going to be a straight line. So all of those scenarios where correlations, two assets where the correlation is between +1 and 0, you expect some sort of variation of shape. It'll go straight, but ultimately we end up with a straight line when they're perfectly positively correlated. There's no diversification effect. That's the point. Okay, so we have the diversification effect. If they're -1 up to 0, then we don't have that happening anymore, because there's no way to benefit of putting them together, hedging one against the other, vice versa. So this is, in general, although I put some numbers here just to describe what we're looking at, this is a general pattern you can expect. And so we come up with the efficient sets and diversification map. All right, so this summarized what I was saying. So anywhere in between -1 and 1, you expect this sort of shape of all the possible combinations. And these are all feasible, like these could be created, but the only ones that are efficient, they would start here when you've done the best you can with diversification, and then you leave the choice looking at the trade-offs. Okay. So remember your axes, return here and risk here. This is expected return of the portfolio now, and this is the standard deviation of the portfolio. Any questions? All right, so what if we have more assets, not just two? So let's see what we're looking at. Let's summarize what we saw for the two asset case. Expected returns and standard deviations vary given different weighted combinations of the two stocks. The feasible set is on the curve Z to Y, but the efficient set begins at the minimum variance portfolio all the way to Y. Segment only, okay? And so, just to repeat, this would be 100% invested in Z and 0% in Y. Something like this would be 75% in Z, but 25% in Y, all the way to 100% in Y, 0% in Z. So now let's look at what we would see if we had multiple assets. What I have here are two at a time. These are the options for taking assets two at a time. And I use this shape, the eggshell shape, half eggshell shape, for two at a time, as discussed previously, because this is between the extremes of -1 and 1 in correlation. This would be a good representation of what you could imagine would be the possible combinations. Then what we would do if we had to choose among all these possible options is we would look left and up, right? Because we want to reduce risk but increase returns. So investors would choose a combination of assets, and there would be more than two, but I'm just showing what two at a time would look like. And this is like a multi-dimensional visualization, really, but the idea would be that on the frontier here, if a point like this would touch on a combination of two or more assets touching eggshells, several eggshells, like these can overlap, right, with other assets, and it'll touch a combination of them with weights summing to a total of 1, and it will be better than all of those that are to the right of it or below it. And that will be the case for all of these. These are all better than those to the right and below, these combinations. And they're also better than any of these, because any of these are inferior to the minimum variance portfolio here. So this brings us to the feasible set. These are all possible combinations inside and outside. So on this frontier and inside here. Those are all the possible combinations. The composite of all asset sets, this envelope here, and in particular the segment here, constitutes the efficient frontier from here to here. So this is efficient. All of these are feasible combinations, but investors will choose some combination of all the assets between here and here. Still, we still have, notice the axes are still the same, return and risk of the portfolio. So we assume that investors are rational, they prefer more to less, and that they are risk averse. So their goal is to move left to reduce risk and up to increase return. So we introduce the concept of domination, or which asset dominates the other. And you can do that, like if I have an asset here, let's say. So this asset A, this asset has lower risk and higher return than any of those down here. But any of those up here are dominating A because they have both lower risk and higher return. So these dominate A. Whereas A dominates all those below. Okay, so this is what you do to analyze an asset, is you would just put an axis running through it. So what about the other quadrants? All of these would be higher return, but also higher risk. So the only ones that A would be indifferent to, well, these would be along here, these would be preferred to A because the risk is not increased, but the return is. So these are all preferred to A. So actually, I should make it clear that this whole quadrant dominates A. Okay? So that's terminology. Now, any questions so far? All I've talked about is risky assets in combination in a portfolio. How do I introduce not risky assets or less risky assets? So I'm going to do this through the idea of short selling. What is short selling? So this is going to help us introduce risk-free borrowing and lending combining that with our risky assets. And it's going to help us determine which combination to choose along that efficient frontier of several assets. So short selling, by definition, is the sale of a security that the investor does not own. How is this done? An arrangement is made with a broker to borrow the security and sell it in the open market. We assume there's no transaction cost in doing that. In reality, there would be a small fee, relatively small fee. At the initiation of the short sale, your only cash flow is the proceed from selling the security. So you'll take the borrowed asset and sell it, and then use the proceeds for whatever you wish. And in the meantime, you look for opportunity to make a profit. How do you close the short? Eventually, you will have to buy the security back. You know, you've prearranged that with the broker of when you're going to have to do that. You have to return the security to the broker to close the short. At the elimination of the short sale, your only cash flow is the price you have to pay for the security in the open market. So as an example, we talk about a treasury bill. The security we're going to use and we're going to short sell is a zero coupon treasury bill issued by the government with a face value of $100 and with a maturity no longer than 1 year. If the yield on a 1-year T-bill is 5%, then we could figure out its current price, right? We know how to do that for a zero coupon bond. It's $95.24. So if you were to short sell the T-bill, you would borrow the 1-year T-bill from the broker and sell it for $95.24. So that's the cash flow from the proceeds. Or the cash flow from the sale. $95.24. By the end of the year, you have to buy the T-bill back 1 instant before it matures in order to return it to the broker. The cash flow is the price that you have to pay for the T-bill in the open market, and so it would be $100. So this constitutes risk-free borrowing. This is equivalent to borrowing $95.24 for 1 year and paying back $100 with an interest rate of 5%. So you created, with the existence of a T-bill, without any other opportunity to borrow funds, this is the way you can, through short selling, borrow at a risk-free rate. Now we say risk-free because in the theory we assume, we use this notation that this is the risk-free rate, or T-bill rate. I can write it as RF or R T-bill and that's because the standard deviation is 0. I'll just leave that out. The standard deviation is 0. So we assume that the standard deviation of volatility is 0, and so doing, notice I don't put an expected return around this. I just leave it as R. So note, no need to write okay, because so there's no need to write ERF because there's no variation. There is no variation in risk-free returns, okay? So this is important that you remember this and that I use RF. All right, so what I'm going to do is introduce, oh, let me ask one thing for the few that are there. Looks like I had something happened to the stream. I didn't notice. Everybody's okay? You can see this and hear me? Okay, so this is risk-free borrowing. Risk-free lending is where you would purchase a T-bill, so that you're lending at a risk-free rate, right? With a return that has no a return that's guaranteed. So this way we have risk-free lending and borrowing. All right, so here we have, I'm going to take that feasible set, so this is the feasible set of all possible combinations of assets, and I'm going to keep us on the same, we have the same axis. Oops. This is the standard deviation of the portfolio. This is the expected return of the portfolio. Okay. And I'm going to introduce, this is the big thing, I am going to introduce the risk-free asset there. What is this? Why is this here? Because the expected return on T-bills is RF and the standard deviation is 0. Everybody okay with that? So this one is the risk-free rate with a standard deviation of 0. So lending or borrowing at the risk-free rate allows us to exist outside of the Markowitz frontier, which is this frontier. This is the efficient frontier. This is the, these are all the feasible combinations. So we can create a portfolio by combining the risk-free T-bills with the market portfolio. What is the market portfolio? When I lay this line down just tangent to the options of combinations, I touch one here. This is one that comprises a little bit of every asset, risky asset available in the market. So this represents, this would be a representation of something like something that an index captures, like the S&P 500 would capture returns on 500 of the top valued stocks, firms from, based on their stock. And this one is the one I would choose among all the others, and it involves just the market portfolio. But anywhere in between here, you have a combination of the market portfolio with T-bills. So this is purely investment in the market portfolio, and this is purely investment in T-bills. Any of these is a combination of the two. So A can be created by investing in both the T-bills, or in other words, lending money, and the market portfolio. Any of these beyond M allow me to increase my return, expected return, simultaneously increasing my level of risk by investing more in M than I actually have to invest. How can I do that? I'm going to short sell T-bills. I'm going to make an arrangement to borrow them and then use the proceeds to invest more into the market portfolio. And that will put me up here. Now I have to pay back, or I have to purchase those T-bills at the end of the, by the time they mature. I have to return them to the broker. But my hope, my anticipation is in the process, I will be gaining the higher return afforded investment in the market portfolio than investment in the T-bill. So that would put me up here. So M is preferred to all of these. That's the point about M. Because without the risk-free borrowing and lending, we're stuck with these, and it's hard to choose between them. We have no other information how to choose between them, because it depends on people's risk tolerance. They're risk averse, and some people willing to take more risk, a little more risk than others. So we don't know which one to pick. By dropping this tangent line, which expands the possibilities, it's a linear combination between this market portfolio and T-bills purchased here, and here short sold. So M is the only option to be chosen among the alternatives here. So what we have done, notice I gave a name to this. This is called the capital market line. This shows you all the possible options. So now, rather than choosing between these, investors choose among these. These are all these are preferred to these. They're dominating, right? These dominate. So we say that all risky assets are in M in some proportion. Some less than others, some very small proportion, but we imagine that all risky assets are found in M. So all investors will have M in their portfolios since they are all on the new efficient frontier called the capital market line. So they'll be investing in riskless T-bills and the market portfolio. Okay. So investors are only concerned with the expected return on the market portfolio and the standard deviation of the market portfolio because the risk-free asset adds no risk. And they're concerned with the contribution of each security, I use the notation I, to the market portfolio in terms of the contribution of systematic risk as measured by the beta. They're also interested, so they can compute the expected return this way. And I'm going to walk you through this. This is the capital asset pricing model. How many of you have seen the capital asset pricing model before? So you might have seen the capital asset pricing model, but maybe you didn't see the Markowitz frontier. So this comes from identifying that all investors will invest in the risk-free T-bill. To be compensated to invest in the risky assets included in the to invest, to be incentivized to invest among the risky assets, they need to be compensated. And they should be compensated by what? This is a measure of the sensitivity of asset I's returns to the market. So for every unit of risk measured by the beta, they should be compensated by this. What is this called? So if you're up to date watching my videos, I talked about this. What is the name for this? Remember, this discussion here. This is in the previous set of notes. The risk premium. What's the risk premium? Remember the discussion about the risk premium? The risk premium, I asked you to calculate all of these. They were calculated as the return, the difference between the return over and above the T-bill rate. Okay, that's, yes, Diana, something like that. So this is the risk premium. So if you watch the video, the risk premium is calculated as okay, so you need to take the average return and subtract the risk-free rate, which is this one here. And here I use the bars because these are calculated as averages of historical data. And it looks like if you calculate 11.7 minus 3.8, to be incentivized to take on this risk, investors require a premium, something extra, you know, like a payoff of 7.9%. That's called the risk premium. And I asked you to calculate those all the way down, and then I did it again here. So for common stock, a risk premium of about 8% historically is seen. So this is the sort of thing we're talking about. Our market portfolio would be like this. In the S&P, there are 500 different companies stock valued, and an index is created, and that follows or tracks the value of investing in the market, and it reflects also market performance. So this one minus this one gives you 7.9. So it's about 8% market risk premium. So the market risk premium is what we're talking about. So this would be R. So what I did here is I did asset class by asset class. What we're going to talk about now is the market. So this is, I don't use the average, I use the ERM, right? Because we are talking about it being the average, but in in the more general sense, if we have ex ante or ex post data, we write this symbol. So this is called the market risk premium. Which I estimate historically is about 8%. So for every unit of risk measured by beta, I want to be compensated the market risk premium in order to invest in asset I over and above the risk-free rate. So this will make more sense when we solve these problems. So what's beta? Beta is, we discussed it, it is the slope of the line that is the prediction line of the scatter plot between assets. In this case, it's the asset with the market portfolio, and we talked about the axis always being M and I. This is always X. I don't know how to help you guys more. You have to watch the videos. If you haven't, you won't understand what I'm saying, so make sure you watch them. Okay? And I didn't give you any extra material because I didn't lecture on Monday. I left you with 3 hours to substitute, and you need to watch them. So this is just the slope of a line, and then there's also this form of the beta. So you need to know these two forms. This comes from statistics, where you learn about this. So from minimizing the square residuals, the sum of the square residuals of the scatter plot to find the line, and you start with the slope of the line. This is R, this is the correlation. This is SY, the standard deviation of Y. On the y-axis we find I, the returns to the company stock, and then on the x-axis you find the returns to the market index, or in this case we call it the market portfolio. Okay? And it's important to note that the beta of the market portfolio is always 1. Why is it always 1? Well, it's going to be 1 because what does the beta mean? It means the sensitivity of a stock's returns to the market returns. And if we pick the stock to be the market index or the market portfolio, it's the sensitivity of the market returns to the market returns is what you're saying. So that's 1 for 1. So that allows us to plot now on a different risk return coordinate axis. This is now going to be my measure of risk, and this is my measure of return. I'm not talking about the portfolio. Notice I talk about the stock. So this is the capital asset pricing model. I am able to determine the expected rate of return by considering the fact that investors will all hold a risk-free asset, and to be compensated to hold that return need to be compensated by the market risk premium for every unit of risk or sensitivity they experience by holding that asset. This creates a line, another linear combination. And what are plotted on the line? The risk-free rate, the market portfolio, and we can also mark the expected return on the market portfolio and the beta of the market portfolio, which is 1. Now all assets are on the security market line. All projects are on the security market line. All assets, all projects, all valuations in efficient markets must fall on this line. So we can use this to determine the risk-adjusted rate of return for a firm for their project analysis. So we're going to practice using the capital asset pricing model for that purpose. So this helps us determine for a firm. So we can use the CAPM to determine the appropriate risk-adjusted rate of return for a firm's assets. All right, let's spend a moment here and then we're going to apply it. This makes a line. What is the slope of this line? What is the slope of the line? Thank you, Daviana. You're always putting your neck out there. Okay, so you're trying. Close. You're kind of close there, but that's not it. So let's see. So the point is, you know that beta is not the slope, right? Beta is not the slope because beta is here. So what you have is, if you want to compare this to a line, this is y equals a plus, this is the x. So that means this must be the b. This is the slope. So you can see it here. I mean, if I wrote beta after, it would be easier to see, but because we don't really write that, right? But this is the slope. This cannot be. This is the x. So let's see. If I go for every unit, I go over here. So the change in x is 1. What is the change in y? The change in y, you'll see, is ERM minus ERF. ERM minus RF. Okay, so that's the slope. Got it? So you're kind of close with what you wrote. All right. So that's why when I express this, when I read this out, I say for every unit of risk, that's like my x, 1 unit change in x, I must be compensated the market risk premium. All right. So the security market line is a line, it's linear, where the CML had just efficient portfolios on it. The SML is for any security or any portfolio, efficient or inefficient. Notice that if beta I is equal to 0, that will force every asset with no risk will have the same return as the risk-free rate. So the entire risk of the asset is reduced to 0, like the risk-free rate. Diversified away. If the beta is 1, the return of that asset must be the same as the market risk premium. And so that security that you're adding would contribute to the average risk of the market portfolio, wouldn't change it. All right, so we use this to determine the returns, the required rate of return given a level of risk. So say we had 2 stock, A and B, and we knew their betas. This was calculated, right, by finding the slope of the best fit line between the asset and the market portfolio. So beta B is more risky than the market. Beta A is less risky. So let's combine them. Well, first of all, let's figure out their returns based on the capital asset pricing model using the SML. So I can do this with percentages or decimals, and I am going to, above the risk-free rate, add 0.8 to the market risk premium. For every unit of the market risk premium. Now the market risk premium is 10%. I'm just going to put in the percentages. So what I'm using is the security market line So you can write it like that. So what we see is that when A has a beta of 0.8, its return is 12%. So if I was to put it on here, I'm going to erase this. So if I put it on here, let's put all the information that we have. RF, you were told that the risk-free rate was 4%. The market the market portfolio had a 14% return. And then we have asset A with 0.8 as its beta. Will be here. And its expected return is 12%. So it works. It makes sense. Fits. Even though it doesn't fit in there, let's make it a little bigger. So that's what you've figured out. Now let's put on B. B would be 4%. So all I change is the beta. This is 1 and this is still 10%. 1.2, sorry. So this works out to be 16%. Then we plot it. So 1.2, I'll put it here. This will be also on the line, it'll be B. All right, so that's what we're doing. We're using the line to trace from risk to return expected, adjusting for the riskiness of the asset, compensating by the market risk premium over and above the risk-free rate. How many of you done this before? Okay. Does it make sense, Daviana? It's not so hard. You can visualize this. So we use the security market line to find the required rate of return for these assets. And next, we want to combine those two assets. Now that we have their expected returns, we want to combine them. If we combine them, any combination of them will also end up on the security market line. So the combination I propose is 60% invested in A and 40% invested in B. So if it was $100, that would be $60 in A and $40 in B. So how would we do this? Well, first, we can find the expected return of the portfolio combining A and B. So we use the weighted average of the means to get that, you see? Remember this, the we create a portfolio so we create a return for every dollar return. Sorry, for every dollar invested, the return will be 0.6 of RA plus 0.4 RB. And so when we take the expected return, we want the expected return, it becomes this. So when you take the mean, whatever you do to the variable, you also do to the mean. So if I take the expected return of that, this is what I get. I don't know if that's too messy. I'll leave it like that. All right, so when we calculate it, we get 13.6. So this is the expected return of this combination of assets. What about the beta? So you can do the weighted mean. You can also do the weighted beta. So this is something new, but it's logical. So I didn't teach you this before. So just like you did the weighted average of averages, you have the weighted beta. So that was a beta of A, that's a beta of B, and you use the same weights, and you get this. So these two values can be plotted now. So you can plot 0.96 and 13.6 and see how they fit. So 0.96 would be more like here, right? I'll do it in red. So this is the portfolio. So that red is the portfolio. And it's just under, it'd be 13.6, just under. Okay, maybe I made it too big. I'll put it, you see it's just under that. It has to hit the line. I can't miss the line. Maybe I'll move it down a little bit. Okay, let's do this again. Just for visualization purposes. So I'll say, I'll put the dot on first. There. And then the line. And I'll ask you to believe this is 0.96. And the expected return to the portfolio is 13.6%. It's lower than 14%, and it should be on the line. Okay, so any combination, if the any combination of two assets that are already on the line will also be on the line in between them, unless I short sell one to invest in the other, then I would expand beyond, just like I did with M and the T-bills. But when they are both less than 1, when the weights are both less than 1, it will be between. What I just said, I'll explain later. For now, it should be on the line and between the other two. Sorry, these two. These are the A and B. And we invested more in A than in B, and that's why we're closer to A. Right? 60% in A. All right, so we've done that now with the portfolio using the weighted average and the weighted beta to get return and risk, but we could have also used the CAPM. We could have calculated the weighted beta and then put it in here to get the expected return, because the line always, the equation of the line always puts us on the line. Of course, these are the same. So you need to remember that either you can use the expected return to get you there, or the CAPM, as long as you have beta. The CAPM depends, it traces risk to return and vice versa. You need one of those to get the other. All right, so that is that. We're an hour and a half in. I gave you a ton of exercises to work on to practice this, applying capital asset pricing model. Actually, I'll leave this up for a moment. Let me give you a break. I'm going to get my next notes ready. Let me know if you have any questions. All right, I'm back. So here are one of the review sets of questions I share with you. And let's go over, you can try all of these. I didn't send you all the solutions. I wanted you to try without the solutions first. And then I'll send them. I don't know, I can't give you that much time alone, but okay, I'll send them tonight. But try and at least read through them and decide where you have issues. All right, so here's a question about the CAPM. Assume the CAPM holds. So there's a number of assumptions that support the capital asset pricing model, like support that it actually holds true. So we're going to assume it just holds true, and that the risk-free rate is 7%. And the expected return on the market portfolio is 12%. Consider the following two capital asset portfolios and that are out of equilibrium. That means they do not fall on the line. So we could plot them. Now, I'm going to try and use a ruler here, make it as clear as possible. So I want you to depict the risk-return trade-off in an illustration that includes the security market line, the two portfolios, the risk-free security, and the market portfolio. Don't forget to label. So let's see if I get a ruler. Can I turn it? Yes. And right now I'm going to just plot I'm going to put down the important values first. So 7% and 12%, I need to mark those. Oh, it goes away. And then I want to plot A and B. I really don't know how this thing works, so I will turn it off. But I got what I really wanted. So this is going to be the risk-free. This is going to be the expected return on the market portfolio, because this is 14, no, that's too much. This is the expected return on the market portfolio. Right? And then the line and notice the line can go back beyond. Betas can be negative, okay? Betas can be negative. We talked about that, I think. Assets that are negatively correlated with the market portfolio could be negative. So this could go negative. So those could be precious metals. I think we talked about it. You can tell me if we didn't. When the market is doing poorly, people tend to invest in, well, lately, cryptocurrencies and metals like gold, platinum, silver. So any companies that either deal in that, or that any securities that are made up of those kinds of assets, well, crypto itself will be negatively correlated, and so their beta will be negative. All right, so we have here the market portfolio, and I want to show, so I put everything on, right? M, RF, and now I want to put A and B. Now A is at 15%. So it's up here with a beta of 1.2. Now remembering why am I picking the wrong one? I don't know. So the beta for the market portfolio was 1. And then for 1.2, let's say this is 1.2 here. Assets should have this level of risk. So let's check out what it should be using the capital asset pricing model. So I'm going to use a star. This indicates where asset A should be. Okay, the asterisk indicates correctly priced risk. So this is asset A's beta. We'll assume that is properly calculated, and then we want to use the capital asset pricing model to find out where it should be. So that would be the risk-free rate, which is 77%. I can use percentages. I'm going to stick with that because it just looks easier. And then add that to the beta of 1.2 and the market risk premium, which is 5%. Right, so I'll make a note here. Market risk premium. Just going to write it once. Because it's 12% minus 7% is 5%. And so this would be %13. So it's supposed to be 13%. But where is it? A is 15%. So now we have to determine, what does that mean? Okay, we're going to do that next. Let's plot B first. So B, with a risk of 1.5, where should it be? So I use the same numbers. I just changed the beta. So it should be higher. It should be 14.4. So B should be up there. Sorry, I'm going to use black. That should be 14.4. Oops. Okay, so those are the correctly priced A and B. That's A and that's B. But where is B? B is at 12, and 12 is down here. So B is below where it's supposed to be. Move it down just a tad. Okay, so this is the red. It's like a warning This is not where it's supposed to be. So what do we say about A? Undervalued. So you need to choose down here. Or they should short or long the investment. We understand, I explained shorting. What is longing refer to? So the nature of shorting is that you believe that the price is expected to fall. In other words, you believe that the stock is overvalued. That's when you short. And you long an asset you believe the price is expected to rise, so it's currently undervalued. So what you're going to do is, if it's overvalued, you anticipate it's overvalued, you find a broker who doesn't agree with you, prepared to loan you the asset, and then you sell it, you make the proceeds, and when it comes time to return it, because the price has dropped, it'll be cheaper for you to return it, and you'll enjoy a profit in the interim. So that's shorting. If you believe it's overvalued, that's what you do. The price is dropping, you'll take advantage of it, make an arrangement where you can buy it you can borrow it and make a profit, because the price will drop. When you have to return it, it's cheaper. You will long an asset, that means that you will buy and you will hold it because you want to realize the price, the valuation going up, right? The higher value stock. So in terms of A and B, which one is overvalued and which one is undervalued? That's the question. Let's look at A. For this level of risk, investors are currently having this expected return. They have this expected return. It's very high relative to other investors receiving this level of return for this level of risk. So this will be attractive to investors. Investors willing to buy this asset will offer higher and higher prices, or they'll offer higher and higher amounts for it. They're willing to pay more for it, and this will increase its price. In the process, where we understand that price for stock, we usually we value it this way, right? We think of the present value of future cash flows. I'm using the simplest form of the expression with the first cash flow, and then imagining that cash flows are constant. If the price is increasing, right now I'm going to replace I with expected return to the stock. As this price is increasing, the adjustment would be that the expected return will fall. Okay, to maintain this relationship, the expected return will fall. So it falls, and just to the point where it falls to the line. As we expected, the expected return should be 13% to compensate for that level of risk, not 15% or whatever it was. Yeah, 15%. So that means the price is rising. This is an undervalued security. So above the line, all these securities above the line are considered undervalued. They need to experience a price adjustment, and that happens once this information becomes available to investors that immediately search for A, and they're willing to pay higher prices, and they adjust the price in that way. So we talk about price in tandem with return. They are inversely related. All assets above the line are undervalued. So you expect all assets below the line are going to be overvalued. So let's explain that phenomena. So currently, at this level of risk, investors want this level of return, but people invested in B are only getting this level of return. So they're willing to give up B. They're willing to sell B. And what they can do to realize this level of return is simply risk-free borrowing and investing that in the market portfolio. So investing all they have and more into the market portfolio to put them here. So they can combine the risky assets and the riskless one to get here. Why would they invest in B? So they'll sell B to end up here if that's where they want to be. So in the process, in the adjustment process, the price, people will offer to sell at lower and lower prices just to get rid of B. And this effectively increases the expected return. And that's how you get the adjustment to the line. So we say that all the assets below the line are overvalued. You anticipate a price drop, so you should short assets that are overvalued because the price will fall and you'll return them at a discount or at a lower price than you actually borrow them for. All the assets above the line are undervalued, so you should buy them and hold them. So that's the way you answer this. So asset A is undervalued. So it's undervalued. You should long it. B is overvalued. You should short it. Questions? Okay, no questions. So you guys can work on those problems. I'm going to start the last set of notes. Yeah, I see a lot of students are not here. I hope they can catch up watching all the videos. I wouldn't recommend waiting until the weekend to watch all the videos because that might be brain overload and it'll be hard to assimilate all the information in that short time frame in advance of the test on Monday. So even if you don't completely understand what I'm saying, I think you should see the material early and then see it a second time on the weekend. Okay? All right, so this is document 515. And this uses the information from case, the UAir case, part 2. Everybody ready? So what we've done with the capital asset pricing model that look like this is use it to price securities, finding the expected return, then that's in tandem with getting the price. So that is called the capital asset pricing model. If we get, as a result, we find the required rate of return for an asset, any asset, or return for a portfolio of combinations of assets. As long as we have the measure of risk, we can calculate the level of return. Another name for the required rate of return, we talked about it, was cost of capital. Another name for it would be the hurdle rate. Another name for it, there's another name. Well, it depends on what it comprises. So if we are focused on an all equity firm, we can refer to its required rate of return as the cost of equity. So for a all equity So let's find the cost of equity. Notice the notation just changed to lowercase, just to get you into the idea. And I'm not sure in the textbook if they go to the lowercase, but what we're essentially finding is the I for all our formulas. And sometimes I use R, right, for return, expected return. That's what we're finding. So moving into the information provided, we're going to calculate both the return and the risk. And we're going to call the return the cost of equity for UAIR, which is an all equity firm, and the equity beta because it's an all equity firm. So I gave you this information on your stock and market ex post returns from 2005 to 2010. So this is actual data. This is obviously a hypothetical firm. And we're going to compute the beta. And what's the beta again? Remember, the beta is found by the market returns here and the stock returns here, and it's the slope. Now with ex post data, it would be calculated like that, but because it's finance, they use different symbols. Oh, and also let me add, it could be calculated like that doesn't look good at all, does it? There's two ways to get the slope. I'll reserve it for the other thing. So it would be this formula. Notice we put hats on because it's not the ex ante data. It doesn't represent the distribution. It is just the sample result. And in the formulas with the finance notation, I demonstrated, that's what we're going to use as opposed to using this, but it shouldn't bother you. It should be comparable. If we were to use the sample results, this would be R. R becomes covariance XY over SX SY, right? And this is SY over SX. So these two cancel. And it leaves this form of beta. It's the covariance per unit of variance of the market returns. So these two formula are for B, for sample data, but they put it in symbols for finance purpose, and they write this. So instead of covariance, they use this hat, and they say XY rather than IM, MS, right? Market and stock, and then this is just the market. So hopefully you can get through this. I should probably check because the textbook was changed. I'm going to check the notation in the textbook and align them, but unfortunately I didn't do it for you guys. But okay, I hope you can follow. You should be able to read this. So we're using S instead of I for stock, and we're using M for market. So this is the formula. We need the covariance. Now, doing it this way, covariance and variance of M, is easier only because we have to make 2 calculations as opposed to 3 different calculations. So this kind of information you could just put in your calculator, so we'll just do that. I'm just showing you what I have here. If you had to do this manually, you could, using the columns as I described. But let's just put it in our calculator, okay? So I'm going to start with data. There's something in there, so I need to clear that second clear worksheet. And I begin entering the data. I'm going to enter them as decimals. I'm going to enter them. Well, it doesn't really matter. The only time it matters if you enter as decimals or percentage is if you want the variance or covariance. But the calculator doesn't give you either of those. It gives you things back as standard deviation, which has the same units as the original values, so it'll all be in percentages. If you were looking for variance or covariance in your calculator, it wouldn't be so clear because those are not percentages, right? Because those are percentages squared. So I guess I can just punch these in because my calculator only gives me standard deviation. It gives me statistics that are in the same units, so it shouldn't matter. So if I put in as pairs, remember S&P, the market index is X, so that's going to go in for X. So 4.91 is going to be entered into 1, and I go down. And then 10, oh no, I have to go put in 10. So Y will be 10% entered down. So make sure I did that right. So that's 4.91 and then 10. Then for the second pair, 15.79 enter down, and then 30 enter down. Then for the next one, 5.49 enter down, and 10 enter down. For the fourth pair, 37 negative, remember that, enter down, and 55 negative enter down. 26.46 enter down, and then 40 enter down, and 15.06 enter down, and 30 enter down. So then we're going to ask for the results, second stat, and we get 6 observations. That's the mean of X. So that's the mean of the market. That's the market return. This is the standard deviation for the market returns. This is not what we're going to use. This is for the stock. This is the expected return on stock. This is for the stock returns, the standard deviation. and that one we're not going to use. And this is if you wanted to make the line. This is the beta, 1.55. And here is that correlation. That's important, that they're almost perfectly positively correlated. It reassures us that this is a good prediction line and the beta is meaningful. Because the R is strong. So that's how you can get those out of your calculator. You see, 1.552038. You could also do this in Excel. But there you go, that's the beta, 1.55. Any questions? All right, so what we're going to do next, we're going to use the CAPM together with the beta, but we need the risk-free rate and we need the market risk premium. So currently, we're going to work with the current T-bill rate, which is 1%. So I'm going to use the current T-bill rate. So I'm going to detract from what I've shown you so far. Rather than putting in the average rate here, I'm going to put the current T-bill rate here. And then for the market risk premium, I'm going to use the market return, the average market return that we got, right? If you go back, remember that was for X. If you go here, no, that's not it. If you go back through the results, the mean for X, that is because X is the market variable. This is the return, the average return on the market, 5.1183. So that's 5.1183. And then we need the average from historical data about the T-bill rate. So this, I also gave you this information from 2005 to 2010. And you calculate the average. You can put those in your calculator and you get 2.365. And you put it all together and you find the value for this level of risk, 1.55, that's riskier than the market, sensitive to the market returns. You get an expected return of 5.27, rather low expected return. When it's low, you're going to accept more projects, right, in any kind of analysis for this firm. A low required rate of return. So this is the required rate of return for you, AIR, using CAPM. And the one thing that, if you look at this again, may confuse you is that I didn't use the same RF here as I used here. And that's because there's been so much change over these years that I'll be more comfortable using the current T-bill rate than to base it on all this historical data that's quite volatile, really, for 3 to 0. So That's why I do that. So it's going to be low. All right. Any questions? So the average historical market risk premium for that period was this. That was using all that data. But I will use the current T-bill rate here, mainly because they're different. I guess that's the best way to say it. Okay, so we get 5%. So now what? What if I use more information? What if I rather than just looking at those 6 years, I go back to 1928 and use the long-term average historical market risk premium? In that case, I'm going to use the market return from that period, 3.7, to get the average historical market risk premium of 7.6. 7.6 is more than 2.75. If I do that, how does that change things? I end up with a required rate of return of 12%. So since this is very different than if you use the last those prior 6 years, this required rate of return will make it much less likely that you accept projects. So the convention is to use the more current data for more robustness, reliable data estimates of the cost of equity. Okay, so if you see a difference, use the more current. So even though I'm able to calculate that, I'm going to stick with this one. Okay. What if I want to compare the cost of equity I computed using the capital asset pricing model? I want to compare that to something else. An alternative model, and I did mention this in the videos from Monday, an alternative model is known as the dividend growth model. The dividend growth model comes from this fact that we use for the case that dividends are growing at a constant rate. We could calculate the price of an asset using this formula. So we could value stock for a firm that has constant growth using this. So in a similar way, why don't we use the same relationship but to find the required rate of return? So that's what we're doing right now. We're trying to find the appropriate risk-adjusted rate of return. Why don't we use this to get it? So if you rearrange this, what you get is R equals C1 over PV0 plus G. As long as you have your assumed constant growth rate and you know the current price and the next dividend, you can estimate the required rate of return. So this is another way that you could get the return or the cost of equity in an all equity firm. So let's see, I'm going to give you this information on UAR's dividend payout. We'll assume constant growth of the firm indefinitely. And then we need to find the right G to use in the formula. So next year the dividend will be let me go to the question paper so you guys can see the question if you haven't seen it. I'm going to go to show you the question, so if you didn't look at it yet. I'm answering the questions in document 5.8. We're solving document 5.8. All right, so all the information is there. You're told that UAR stock currently is traded for $10.25 per share in the open market. The corporate tax rate is 40%. And I say use the CAPM, so that's what we just did, and the dividend growth model, so that's what we're going to do, to estimate the required rate of return for UAR stock, where we assume, or at this point, we're saying it's an all equity firm, so it's cost of equity, capital. Discuss all your assumptions and difficulties. Okay. So there's the information that we're dealing with. And we're trying to figure out in 2010, with all that information, they're looking at opening the new line. So this is just the information from there. So what we're going to do is find the G we need for our formula. I make a point that this is the return to the stock, so this is RS. This is like our ERI. But we use the notation RS now. This is the equivalent of finding the interest rate. That's why I put the I there. And, oh, I should have put I here, sorry, because this is I. Because in our notes, I use I, not R. I don't want you to think there's new things going on. So I need the dividend I need the price, and I'm doing this for year 2000, and I'm doing it for 2011. So if the price is currently $10.25, the dividend, we need to find the next period's dividend and G. So to get next period's dividend, we need G. So everything depends on G. So we need to get G. To get G, we sort of cheat and we say, well, 6 periods of growth. So 1, 2, 3, 4, 5, 6 periods of growth between 2005 and 2011. Remember the discussion about intervals versus payments, right? There are 6 intervals, so 6 periods of growth from 2005 to get to 2011. So I put in my dividend in 2005 and 2011, and I solve for G. G ends up being this number, and I use it to get the next dividend in 2012. So this will be the next dividend. This is the G, right? This is the next dividend, and this is the price. Oh, why do I have that number there? I knew I had a typo somewhere here. That is, I think it still works out though. I gotta fix that in my notes. This should be 10.25. I think it still works. Yeah, it's just a typo. Okay? Is that all right? So what we found now is through the capital asset pricing model, we got 5% as our required rate of return. Using the dividend growth model and other information, we got it's about 6%. So that's good. That's comparable, right? Those are similar. That's important. Now we have to decide which one to use. I think I decide to stick with the capital asset pricing model because they are similar, but I want to emphasize we're going to stick with the capital asset pricing model because I want you to learn that. But I also want you to learn this as an alternative. So what you could do is analyze with both, right? We're going to look now at the UR case. Remember, we already have the total project cash flows projected. So either of these are easy to compare with the internal rate of return. So let's look at that. Suppose UAir is an all-equity firm. The New Bahamas project will generate these cash flows. Remember these. We calculated those, or I showed you how to get those. And we assume that the Bahamas project beta is the same as UAir's beta. Okay, so that's a big assumption. It's not necessarily true. A project that you're starting that's new could be more risky. But we'll use UAir's beta for now. And we got 1.55 and used it already. So we have all these calculations. Now remember, getting these cash flows, we were able to get the internal rate of return, and we got 10.26. So this is what the project return. We interpret that because it's an investment type project. We compare that to the required rate of return. Whether we use 5% or 6%, we should invest, right? So the 5% CAPM is exceeded by this project. If we were to use the other CAPM where I use the historical data, we would not, the historical data back to 1928. You can't see that, can you? Let me make it. We would have rejected the project if we used this CAPM. So it's important to understand the sensitivity of your result. We argued that they were so different we would stick with the more current data in our analysis. All right, so then even if you use this new required rate of return that we calculated, we should invest. So you could do it with the IRR comparison, you could do it with the NPV calculation. So 5.2732 was calculated, remember, over here. All right. So in this setting, if you use CAPM, you end up here. This will be the appropriate risk-adjusted rate of return for UAir because UAir's beta is 1.55. The project puts us here. So this is a valuable project. It's currently undervalued, right? So we should take this project and pursue it because it's up here. So remember, you long and hold. So notice that you can analyze projects. Projects should fall on the SML as well. All investment opportunities fall on the SML. Okay, so that is regarding all equity firms. I'm going to stop here because it's 10:34 and you have lots to review. I'm going to pick up here tomorrow and hopefully more people will show up and I'll summarize about using WACC. Now you should have learned about WACC in 3106. So you can go ahead, study, and then I'll talk about it more tomorrow. But you should get going on your work, reviewing those exercises, okay? So I will stop here about 10 minutes early, 15 minutes early. Do you have any questions for me right now? So I'll spend 1 hour next class doing whack. I'll solve a problem with you, and then I'll get to the new material. Okay? Any questions? So tomorrow we're going to start the new material. I'll send it. And I'll send the solutions to those exercises as well that I've just sent. I should tell you, I also posted another assignment in Connect for you to practice. Okay, bye for now.